Good afternoon, ladies and gentlemen. Welcome to the One Heritage Group PLC interim results investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, if I may, I would like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I'd now like to hand you over to CEO Jason Upton. Good afternoon, sir.
Good afternoon, everyone, and thank you for attending our interim results presentation today, which covers the 6 months to 31st of December 2022. I'm Jason Upton, CEO of One Heritage Group, and I'm again joined by Anthony Unsworth, our CFO, to run through our presentation. So to start, a reminder of who we are. We are a residential property development and management company, and we focus on developing high-quality, self-contained apartments, both refurbishment and new build property, along with the development of co-living accommodation. Our business has 3 core elements: principal developer for our own residential developments, development management for third-party owned developments, and property services. And our core focus is the residential sector in the north of England, and have recently had our 2-year anniversary on the main market at the London Stock Exchange, having achieved our listing status in December 2020. Strategically, we have 4 objectives in place for the current financial year: to deliver our development projects, of which during the financial year we had 4 of our own projects as principal developer under construction, which should all complete before the end of June, and a further 2 development management projects. Of these, we have already completed 1 of our own as principal developer, with another which should follow within the next week, and a further 2 due to complete between now and the end of June. Our first development management project was completed earlier this year, and the second due to follow post-year end in quarter 3. And as we complete our developments, the focus changes to ensure our purchasers successfully complete their transaction. And demand's been strong, securing high numbers of reservations across our developments. But sale completions come with their own challenges, which is why further improvements to our processes are and will be made to ensure revenue is generated in the quickest time frame as we possibly can. And whilst revenue is expected to be strong in the second half of the year, as we benefit from the sales of our finished property, we have focused on adding some revenue diversification from our services. And whilst development management makes up the majority of this, we have seen increases to our property management income in particular. And finally, with developments completing, we're working on securing the right opportunities to replace these. And whilst we're operating in a competitive market due to a shortage of consented sites, which has been impacted by a complex planning system and delays over the last few years due to COVID, we are seeing opportunities and believe we're well placed to take advantage of these over the coming months. So to recap our strategy, we have 3 core elements. Firstly, we're a developer. We acquire land or buildings for residential development within the group. We primarily develop residential accommodation, either new build projects or the conversion of existing buildings, such as former offices or other commercial premises. Our geographical focus is the north of England, primarily city or town centres with high demand from working professionals with good transport links. And these areas tend to have similar characteristics in terms of values and expected economic growth. Secondly, we act as development manager for schemes owned by a third party. We have had 4 projects under a development management agreement during the financial year and have recently completed 1 of these in January this year. And these agreements generate regular monthly income for the group and a profit share upon completion. And finally, the third core element of our strategy is our property services, which includes co-living, construction and property management, which has has grown over the period, and we now have over 380 tenants in properties under our management. And what we also believe gives us a competitive advantage against other developers is our wider network in Hong Kong and Asia, which we're demonstrating by securing strong reservations of properties under construction. And this network's mainly through our majority shareholder, One Heritage Property Development, who are based in Hong Kong and provide the UK group with a key sales and marketing function. This slide's an overview of our developments. I'm pleased to see our Lincoln House development completed last year, and Oscar House should complete within the next week, with Bank Street to closely follow around a week later. St Peter's Gate is expected to complete in the summer, and with planning permission already granted, a start expected on Victoria Road next, our first new build housing development. Seaton House does have a pending planning application, and Churchgate, as reported in our results, is under review as we may choose to sell the land given the size of the project and location. And we have had some mixed performance of these projects. The positive is we're bringing those under construction now to a conclusion, but we have had a number of impairments which we announced last year following a contractor insolvency on our Bank Street project and the development managed Queen Street project, which prompted the decision to finish the developments in-house along with our St Peter's Gate development as a means to minimise cost, which also saw with a number of other residential developers. But subcontractor shortages and rising costs without the security of a build contract with a principal contractor has impacted these projects. We have since decided to cease participation of in-house construction on residential projects, and have undertaken a restructure of our team, which has seen a number of new hires, including a highly experienced interim development director and the head of projects, with more hires expected over the coming months to further strengthen the team. And although performance has been mixed, specifically financial performance, it has been against a challenging backdrop. But with projects now completed under our belt, we have an even stronger platform to build from over the coming months and years ahead. We had 4 development management projects, which became 3 at the start of the year following the completion of the courthouse in Oldham. North Church House is under construction, which is due to complete in the second half of the year. And we expect to sign the build contract at 1 Victoria within the next few weeks or so, which will see a formal start on site. One Heritage Tower has been a challenging project. We have had success achieving planning permission and are now in a PCSA with a principal contractor. And I'm expecting to be able to report further progress on this project over the coming months. And revenue from development management has been valuable to the group as we benefit from consistent sources of revenue without risking capital on these projects. And newest development management project, for example, 1 Victoria, should generate hopefully over £18,000 per month in fees for the next 2 years, which will equate to around 2% of the development cost, in addition to a 1% fee generated of any finance secured and a profit share upon completion, which is set at 15%. Our sales have had mixed success for a number of reasons. Demand has been strong, which has been demonstrated with high levels of reservations, but we have had some delays converting reservations into exchange contracts and then sales completions once the development's finished. Usually the target is for purchasers of exchange contracts to complete around 14 days following the completion of a development. What we've seen with Lincoln House in particular is a long period between reservation and exchange initially, then buyers encountering a number of challenges when it comes to complete their purchase. We have, however, implemented new processes to reduce this impact in the future, hiring an experienced sales progressor to improve the engagement levels and with buyers and sales agents, for example. Additionally, we're looking at adding some diversification to our sales strategy. Whilst overseas sales has had success, we're looking at options, which is what we did at Oscar House in the form of an underwriting agreement for all 27 units, and Victoria Road being a new build housing development will likely be sold to UK owner occupiers, all offering some variation across our sales. But we continue to see strong demand in our property, and a reassuring indicator in our business model. Our property services had other consistent sources of revenue, aiding our property sales, and allows us to provide vertical integration across all stages of property development, including post-completion. The majority of revenues generated from co-living, which essentially sees us generate income from sourcing property, the transaction to purchase it, the project management through refurbishment, the transaction fee once sold, and the ongoing property management once the project is completed. We manage both co-living and residential property, however, tend to not take on the full property management of co-living properties, considering the volume of tenants and multiple locations across the north of England, which would be resource intensive to manage ourselves. We retain only part of the management, such as managing the landlord and distributing rental statements, then outsource the day-to-day management of the property to a local agent. And these additional sources of revenue add diversification and continuity, which is beneficial, considering the capital tied up in development projects, which may last 1 to 2 years. And I'm now going to hand over to Anthony to run through the financial review.
Thank you, Jason, and good afternoon, everybody. So let me take you through the key aspects of the financial performance for the half year. So we'll look at the numbers on the performance slide, and they show we have delivered a strong sales performance, but profits have been impacted by the impairment of assets. For the first 6 months of the financial year to June 23, group revenue was 5.8 million, which is 5.6 million higher than the prior year, delivered by development sales and in-house construction services. Development sales revenue of 3.3 million was the largest contributor to the group revenue, accounting for 57% of the total. So this significant growth was driven by Lincoln House Bolton, which practically completed in the half year and delivered 27 legal sales completions in the period. Construction services delivered revenue of 1.9 million in the period, reflecting building activity supplied to related parties on co-living refurbishments and refurbishment of Queen Street, Sheffield. Property services also saw an increase over the same period last year, from 30,000 in H1 22 to 0.3 million in this set of interim results, and that's been driven by management fees and transaction fees. Development management fee income was 0.2 million, and this was generated from 3 projects: North Church House, Sheffield, the Tower, Salford, and 1 Victoria, Salford. So for revenue, a strong performance, and it's the largest the group has seen to date. The quality of the group's revenue has also improved, with sales to related parties down from 100% last year to around 38% in these results. Now, moving on from revenue, there was a loss at gross profit level of £0.3 million, a £0.4 million reduction on last year. This was due to a £1.1 million impairment on 3 developments: Bank Street and St Peter's Gate, which were impaired in June FY22, and Oscar House. A number of factors have led to the impairment, which are delays across 3 projects during the period under review, cost increases mostly attributed to rising construction costs on projects where we act as principal contractor, and increased financing costs impacted by the delays and fees for extensions. There's been a number of significant changes implemented to reporting, risk management and operational delivery to better protect the group from similar challenges in the future. Looking at the gross loss from a business segment perspective, on note 2 to the right of this slide, you will notice that development sales would have delivered a profit of 0.2 million had it not been for the impairment of 1.1 million just mentioned. In-house construction delivered 90k of profits, and property services and development management are two key revenue streams for the group, each delivering 230,000 of profits. Now to look at administration costs, which were 1.1 million in the period, up 0.4 million on last year, driven by an increase in average headcount to 28 employees from 23, along with the associated recruitment costs. The group remains focused on tight control of overheads, whilst introducing some investment in cost to benefit revenue streams. We also internally and externally review administration costs by business segment to ensure they are right-sized for the revenue delivery and to maintain a tight control of all overheads. Operating loss was 1.4 million, 0.9 million lower than last year, and the group generated a pre-tax loss for the period of 1.6 million. The loss per share was 4.1 pence, higher than the 1.6 pence last year. So with the half year completed, we now have line of sight on the year end. There is a clear focus on the core operational areas of the business. Roles and responsibilities have been reviewed and are aligned to the sources of revenues and profits. Learnings from the impairments have been incorporated into the group's risk management. Now, with a growing pipeline of developments and the strengthening of the teams to deliver, the group is in a strong position to achieve controlled growth and shareholder returns. Turning to our balance sheet now and some of the notable changes. The cash and cash equivalents of 0.4 million I'll cover in a moment. Down to inventory, which increased by 2.7 million since June 22, with expenditure on developments due to practically complete in the financial year to June 23. Oscar House, Bank Street and St Peter's Gate increased by 2.7 million in the period. Victoria Road, Eccles Hill was purchased in the half year, increasing inventory by 1.2 million. And the 27 sales completions at Lincoln House have reduced inventory by 1.4 million in the 6-month period. Trade and other receivables reduced by 0.4 million, mainly due to improved debt settlement processes. Total borrowings increased by 2.2 million. The group carefully utilises debt to support investment activity through construction loans, a corporate bond, and a shareholder facility with our parent company. This increase is funding the inventory growth until our customers complete on their purchases, which will satisfy the finance, reduce inventory, pay down the shareholder facility, and also provide valuable working capital, helping to fund the next cycles of activity. Net assets reduced by 0.3 million in the 6-month period. The net asset value per share was 0.6 pence in the period. In summary, the balance sheet structure reflects the anticipated impacts of forward funding development projects with a combination of increased debt and equity instruments. Ahead of completing significant developments in the second half of our financial year, the group increased its borrowing levels in accordance with the strategy adopted by the group, supported by focused equity placements where appropriate. As the group continues to progress and with development projects reaching completion and realising sales, the balance sheet will in due course reflect the positive cash impact of such transactions. Moving to cash flow. This slide demonstrates how cash has been utilised, strategically adding planned borrowings and an equity raising to support the increase in inventory to complete our developments. So looking at this slide and starting at the left, The loss for the group was £1.6 million, as I just described on the performance slide. The cash outflow for working capital was 1.7 million. So inventory was the material change, with the group investing in 3 developments scheduled to practically complete in half 2 of our current financial year. As a reminder, it's Bank Street, St. Peter's Gate and Oscar House. The net impact of the loss and investment in working capital is an adverse operating cash flow of £3.1 million. This cash outflow is robustly financed with continued strong support from our parent company and external finance providers. Financing cash inflow was 2.4 million. A subscription with existing and new investors raised 1.3 million, and there was an increase in borrowings of 4.5 million from external parties and related party loans to support development. Repayments of interest and borrowings were made in the year of £3.3 million, resulting overall in a net cash outflow in the period of £0.6 million. So finally, before I hand you back to Jason, picking out the key summary points of this financial overview. Revenue is 5.8 million, up from 150k the previous year, so a strong sales performance. Operating loss 1.4 million after an impairment of 1.1. Net debt 17.7, and a subscription with existing new investors raising 1.25 million. The business is expected to practically complete 3 further developments in H2 FY23, and we have continued committed support from the parent group. We're in a strong position to achieve controlled growth and shareholder returns. Thank you for listening, and I'll now hand you back to Jason.
Thank you, Anthony. So as highlighted earlier, there are 4 strategic priorities in place for the period. We've seen good progress finishing our first project, along with our first development management project. 2 more of our own development projects are due to finish within the next few weeks. And all these demonstrate our ability to deliver a good product and have been significant milestones in our journey. Our sales and property services growth will be critical to generate revenue, and new projects will need to be identified to build our pipeline. We remain on track to deliver strong revenue for the financial year, with expected sales of our completed developments, of which 4 are expected within the financial year. There are ongoing challenges and cost pressures affecting the industry, which we have adapted our strategy to and taken measures to counter these. We are, however, seeing signs of improvement in the market, which gives us confidence that costs will stabilise in particular. We will need new acquisitions, but the timing of these will be critical. We are in a competitive market, and there is a lack of supply of consented opportunities, but we are in a strong position to capitalise and are already seeing some good opportunities in the market we hope to come to fruition over the coming months. And overall, the outlook for the whole residential market remains positive, with forecasts predicting the North West and Yorkshire will be in the top 3 leading regions for growth, which is where all our developments are located. And this week we saw Zoopla announce that rental properties had reduced by a third, and demand for rental accommodation risen to more than 50% above normal levels. So clearly high demand, which we're seeing ourselves with high occupancy levels across our property. And thank you all for listening, and we'll now take some time to answer any questions.
Jason, Anthony, that's great. If I may just jump back in there, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Anthony, Jason, we did receive a number of pre-submitted questions questions ahead of today's event. And as you can see there in the Q&A tab, we've also received a number of questions throughout your presentation this afternoon as well. So firstly, thank you to all of those on the call for taking the time to submit their questions. And Jason, Anthony, if I could just hand back to you to respond to those questions where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
I think if I go first, we've had five questions issued to the group before this presentation commenced. Question number one is a question about one of the notes in the interim report, looking at business costs and how are they aggregated across the different segments of the business. So yeah, thank you for this question, and I'll try to answer without getting too technical. So segmentation of revenues and costs to understand the profitability of our revenue streams is critical to ensure our strategies are delivering in accordance with what we expect. We also have a statutory requirement to provide an audited segmentation in our annual interim report. And with the support of KPMG, we included this for the first time in June 22 and for the second time in these interim results. And as our business grows, the segmentation will evolve alongside the strategic objectives and could increase in granularity. Now, specifically in terms of this question on how costs are profiled across the segments. So salaries of the teams are segmented to the relevant business units in line with the revenue stream being driven. The remaining overheads after salaries are to a large degree corporate related and predominantly including colleagues in corporate roles, expenditure on audit, advisor support, investor communication fees, and the cost of running the office we're based in. So hopefully that gives you some context of how the costs are allocated in that segmental matrix in the notes in the interim report. The second question was to look at, again, in terms of segmentation, co-living and property services are amalgamated. So again, thank you for this question. And the simple answer is that they are reported together because these revenue streams have a dependency on each other. And it's the same team that delivers across these key areas of the business. So property sourcing and property transactions were explained by Jason earlier and are a key part of the co-living offer to our customers. And then following refurbishment, we manage these co-living tenanted properties for landlords. So hopefully that adds a little bit of colour and explains why they've been reported together.
So I'll ask the next, I'll answer the next question. So I've got how many of the Bolton units are now sold, how many are exchanged, and how many are in the early stages of the legal process. Are the units being marketed in the UK as well as overseas? And sales are clearly not going well. Have prices been realistically benchmarked against the current market? So there were 27 units sold and revenue recognised in the results, and a further 21 since the start of the year, meaning 48 sales have been completed from 88 available. We have a further 8 that are reserved and 32 unsold, which are a priority to secure sales over the coming months. There have been various reasons why sales have performed the way they have. Legal completions of the 48 units has taken longer than we expected, mostly due to conveyancing issues. In terms of the volume of sales, we did have a bulk purchaser for 47 units that didn't perform last year. And we have had around 10 buyers fail to exchange contracts after paying a reservation fee, leaving 57 units available around 6 months ago. And of these 57 units, buyers have been secured for 25, leaving the 32 unsold as of today. But how we remarket and the timing of sales is key to prevent impacting values and losing existing reservations, which have been at risk. Recently, we've focused on reservations moving to exchange contracts and essentially committing buyers legally before we look at changing sales strategy and offering any incentives. Ultimately, unsold units haven't just been a result of pricing, more the circumstances and constraints which is focused on existing reservations and securing revenue before we change approach. And whilst our first completed development shouldn't really be a reflection of future performance, we have identified a number of changes to improve the effectiveness of sales, including the implementation of new Salesforce software, which allows us to better manage sales and any agents, along with an experienced sales progressor being added to our team who joined the team yesterday. We are now completing the legal completion of the remaining 8 of the 56 sales secured, have cleared the construction finance, and whilst we continue to sell the unsold units, we are collecting rental income in the meantime, and the building is 100% occupied.
Okay, thanks, Jason. If I can answer the fourth question. The fourth question is around one of our developer manager projects, which is Queen Street. A query about what are the risks in Queen Street and what measures have we put in place if some of this risk crystallises. So again, thank you for this question. In terms of some background first, again, Queen Street is a project where the group is acting as development manager. And as a brief reminder on the agreement we have with regards to fees for the group, which fall into 3 areas. Firstly, the group earns 2% of total development costs as a fee, and these are paid monthly over the period of the development. Secondly, a 1% fee is paid on the debt finance raised. And finally, there's a profit share where 15% of net profit is paid on completion. So in terms of risk, the profit share is the variable element, and clearly any deterioration in the profitability of the scheme will impact this profit share element. And in terms of what have we put in place to manage this risk, the losses to the group arise if there's a deterioration of profit, and losses to the shareholder of that project as well. We have regular review meetings that take place with senior management and with external debt providers on site, where performance is regularly reviewed, and if there is any issues crystallising, we can then put in corrective measures where appropriate. I think one last point on this, the group hasn't recognised any of the revenue in the numbers I've just gone through on profit share because the developments are in the early stages of construction and there's too much uncertainty to reliably estimate that expected revenue. Hopefully that gives, again, some colour on that query.
I've got a question here. Are all claimed reservations based on exchanged contracts? Are there any grounds that a buyer can legitimately renegade on their commitment across projects, for example, due to late delivery? So sales normally go through 3 stages. Reservations where a buyer reserves the right to buy the property and pays a fee. This provides the buyer exclusivity during a period to move to the second stage, which is exchange of contracts, which is the point at which the purchase is legally binding and the buyer pays a deposit. And finally, the third and critical element being legal completion, which is the point at which we're in receipt of funds and can now recognise revenue. But the grounds the buyer could renegade on their commitment is either a reservation by forfeiting their reservation fee or exchange contract without losing their deposit if a long stop date is passed. I've got another question here. When do you expect the remaining legal sales of Lincoln House to be completed? Have you had further interest in the unsold units for Lincoln House. So I think I covered this in the response to the earlier question. We've got 48 units legally completed, with 8 due to legally complete over the next few weeks, hopefully. There's 32 unsold. We have had an offer for 20 of those 32, and interest in a further 3 properties over the last week. So we are seeing interest, but our focus has been to get the reservations over the line, and we'll reassess what the options are and what the right option is going to be to secure the sales on the remaining 32.
If I can take another question that's come in while we've been presented, and it's quite a brief question. What is happening to house prices? Again, probably a lot is written in this field. What we've seen signs of is some slowdown in the housing market, and property prices seeing some fall from their peak levels. So the latest official data we've seen from the Land Registry shows year on year in January a 6.3% increase. However, when you drill into the detail, in January UK house prices fell on average by 1%. So there is some property price fall out there in the market. Now, back in October, you would have heard of price falls of as much as 15% as the mini budget took hold. But thankfully, these claims have become more muted as the months have gone by. When you look at a Savills report that was issued in March, they estimate a UK price increase over a 5-year period to 2027 of 6.2%. And within that, when you break that down by region, our trading area in the north is expected to outperform the UK market. So the UK market at 6.2% and our trading area is 12%. However, this increase of 12% in our trading area and 6% in the UK, as you look at it over the 5 years, Savills are suggesting it isn't a linear change, and they are forecasting a fall in 2023, but a relatively fast recovery as we get into 2024, and then increases from that point on. So I think inevitably, much is going to depend on consumer confidence, the impacts of efforts to control inflationary pressures, and what happens to bank interest rates. Also, I think mortgage rates, they still remain elevated from what we've seen over the past few years, but the mortgage rate competition is increasing. I think all that said, the market fundamentals, we believe, remain very strong. The demand for good quality housing continues to outstrip supply, and lenders continue to want to lend. I think further to that, focusing on One Heritage, rental values outside of London are expected to grow by over 18% in the 5-year period, according to Savills, and 6.5% of that is increased forecast in 2023. So it is our belief that One Heritage is in the perfect position to capitalise on these strengths and deliver a quality product.
Yeah, I can answer the next question. You talk about the changes made to improve the delivery of your projects in the results. Can you elaborate on the team structure and strategy? Yeah, so I guess to address the team first, our original strategy was to have a lean development team and staff responsible for all aspects of a development from acquisition through to completion. But adding developments over the last few years, which has grown to, I think, 11 now, which we're responsible for, has been the strategy of having staff responsible for the whole development was unsustainable. Not only providing difficulties to recruit people with this skill set, and to have the consistency between them. That means that there is sometimes single points of failure, which, considering the risk of likelihood and impact this could have, and has had, meant improvements have been required to establish a more robust structure, which ultimately both reduces risk and improves delivery. As a result, we've moved towards that of a traditional larger developer by having specialisms and multiple people involved on projects, which adds experience or expertise and gives us greater control, which is something we didn't really do early on because of the small volume of projects, but we now have scale to sustain this structure. Therefore, we've gone from having a team of essentially cradle to grave development surveyors and development managers to a team with specialisms, which includes acquisition, pre-construction, project management and cost management. And these specialisms will be added to and will be the core structure for the years ahead. In terms of delivery, we adapted during COVID and to the challenging market conditions over the last few years, which was consistent with a lot of other property developers. Ideally, we would have had fixed price build contracts in place, but it's been unviable over the last few years with the level of risk pricing and high inflation contractors have priced. And if you were able to secure contracts that the price and level we were targeting, these did present risks of insolvency, which is what we saw in a number of our projects. But the market shifted. We're seeing tender returns come back in line with our appraisals recently. But despite this approach, we have been targeting de-risking developments by progressing design as much as we can prior to contract. And this gives us price and design certainty entering into contract, which will reduce the risk of any variations or cost increases. Therefore, more robust contracts will be in place moving forward with fixed costs where we can, or contracts with more cost certainty. Additionally, we've seen with the smallest developments, these are the ones that have been impacted the most. And this has been due to a few reasons, partly with no disrespect intended to the contractors operating in this part of the market, but they do tend to have less creditworthiness and experience increasing the risk of insolvency in particular. And we're unlikely going to take on sub 20 unit schemes for this reason in the future, and partly why we are considering selling the land at Churchgate in Leicester at the moment. But overall, confident in the changes implemented, but unfortunately these aren't quick wins. They will take time, but essential changes to future-proof and safeguard our success over the coming years.
We've had a question on within the finance update. There was a reference to finance costs impacting, and the query is what lessons have been learned. There's also another question about why was Oscar House impaired when it was a fixed price contract that was awarded there. I think if I can tie them two questions together. Previously the group has sourced construction finance, and it's by approaching a small number of lenders, arguably without the expertise in place of somebody who's an asset manager who's got a day-to-day exposure to this market. We've seen on one of our developments, which is Oscar House, an escalation of financing costs, where the extension of that financing cost and the duration of them financing costs have significantly impacted. In the half year, though, I'm delighted to say we have agreed a partnership with an asset management firm, so a professional treasury specialist, and they have access to, I believe, up to 90 lenders, and a number of them are high street lenders. So they are going to support the group through the next chapter to source the most appropriate finance solution, ensure best value and terms are delivered for the group.
I can answer the next question. You mentioned a challenging environment for acquisitions. Please can you elaborate on the acquisition strategy moving forward, number of sites, beds, etc. So we will need new acquisitions to at least replace the developments we're completing. We're still seeing good opportunities, but deciding when and what acquisitions to proceed with will be dependent on a number of factors, including the price we can secure the opportunity for with sites in high demand. These values are still strong, and we are facing fierce competition. The build price, which has increased over the last few years due to inflation and pricing of risk, but we're seeing signs of this flattening, which is giving us confidence. And finally, what we're able to sell it for, with demand from investors still strong. It is a competitive market, which is why we're adding some diversification to our sales strategy. But in terms of what, as I mentioned earlier, it will likely be schemes in excess of 20-30 units to move away from the risks that the smaller developments have presented, and why we're considering selling Churchgate in Leicester, as I mentioned, but unlikely to have build times in excess of 18 months. So the core size will likely be anything from 20 to maybe 120, 130 units. In terms of location, the north of England continues to be our focus. We're seeing some good opportunities in the area, and well poised to take advantage of those once equities within the group post the completion of the remaining developments and revenue generated from the remaining sales.
I've got a query on the cost of admin expenses, excluding staff costs and the sort of activities that are in that cost. I did allude to this in the first question on big business segments. I'm not sure if this question came in after that or before that, but either way, just as a reminder, some of the key areas of expenditure that are not staff cost related is expenditures on audit, advisor supports, investor communication fees, and the cost of running the office. I think there's another question here on reservation activity in the last 6 months. So yeah, we've gone to market publishing our current reservation rates. I think as you run down that table, Lincoln House, we've now published 56. We were at 52, so a net +4. Oscar House, no change, 27, all fully sold. Bank Street was 22, it's now 20, so a reduction of a net 2 there. And St Peter's Gate is fully sold at 18. It was fully sold in June. So they are the headline numbers. As Jason mentioned before, when a customer reserves, that buyer reserves the right to buy the property and pays a fee. However, the customer can pull out of that reservation up to exchange of contracts without material financial loss. So whilst there's small changes there in the reservation numbers, cancellations have been replaced with new reservations where appropriate.
I've got a question about the property operations and development directors I've left in the past 6 months. Going on the website, are they expected to be replaced? So we announced earlier this year an interim development director, the highly experienced interim development director who's come into the business and will oversee the development team moving forward. And the property operations area of the business is currently under review as we are looking at having a leaner structure, reviewing our cost base, and expect to share further information later in the year when updated structures and strategies become clearer.
A question on Queen Street, just to we want some elaboration on taking the construction in-house. Is it fixed price or cost plus? Yes, we provide the construction activity for that site, and it's on a cost plus basis for the group. And then there's a further question following the points I think I've just made on Treasury advisors. How much will the Treasury advisors cost? There is a fee for this professional service that we're going to get, as you would expect. The professional advisors have access to a portfolio of up to 90 lenders compared to what we can do here, which is no more than a handful. And the group has experienced some losses by entering into some finance contracts that have not been as clear in terms of costs as we would expect. So there is a cost to enter into a finance agreement with the Treasury specialist, but with the portfolio of lenders coupled with minimising some of the risks we've seen, we believe we'll be in a much better position.
And I think that was it for the questions.
Jason, Anthony, if I may just jump back in there, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors this afternoon. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the Investor Meet Company platform. But Jason, just really before really redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, so I guess thank you for attending our interim results presentation this afternoon. It's been a challenging but rewarding first 6 months of our financial year as we complete our first developments as both principal and development manager, with further completion due over the coming months. Performance mostly been as expected in difficult market conditions, but we have adapted our strategy and measures taken to counter these. It will take time to see the benefits of the changes, but we're in a far stronger position than we were 6 months ago. We continue to remain confident in our business model and strategy. Housing continues to be in undersupply and demand remains high. With progress being made with our strategy, we're certainly looking forward to the months and years ahead. And thank you again, and enjoy the rest of your day.
Jason, that's great. And Anthony as well, thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of One Heritage Group PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.